Did we lose Finney?
I heard you were looking for
I was
us.
gonna say, I think he came for you.
We were, we
I'll just text.
found Brian down at the bottom there, so he brought us.
The door.
So.
There's.
Hi, good morning. Sorry, I can't be with you all in person today. And I think I shared with Milt that I have a client obligation that just popped up, so I have to leave at 10 a.m.
Understand. Okay, there we go. We also have joining us, Sharif Ansari was, also had conflicts. And he was just asked by the county council just a week and a half ago, so we could work around those. I have already, Sharif, provided your bio. Meeting with fill in the gaps. What we already know. You hear me okay?
I'm not hearing you that well, Milt. It's kind of breaking up.
It's kind of garbled.
All right, let's hold on for a second. Sharif, can you hear me now?
That's better.
Sharif?
Yes, a little bit clearer. Good morning, all.
All right, fine. Let me just repeat what I said before. I've already passed around your bio very liberally to the members of the board. So we are all familiar with something of your background, but at the next meeting, which I hope you'll be able to attend in person, I'd like for you to take the board through your background and somewhat more detail and provide a little bit more color.
Of course, absolutely.
Okay, very good. All right, let's have a roll call.
Brian Hanson.
Here.
Paul Hample.
Here.
Lieutenant Colonel Gerald Lohr.
Here.
Jody Patterson.
Finally,
Here.
back from the wars.
Anthony Waskowitz.
Sure.
Milton Wilkins.
Here in body and spirit.
And Sharif Mansari.
Here,
Okay, we first order of business is approval of the minutes of the regular board meeting. Well, we have the minutes of the closed board meeting of January 25th, but on here as well. But let's talk about the regular board meeting of February the 27th. Everyone's had an opportunity to review those. Do anyone have any suggestions? Amendments? Objections? All right, may I have a motion to approve the minutes for the February 27th meeting?
So moved, Hample.
Jody Patterson seconded. She just didn't know it. It was in her mind. I could sense it. May all those in favor say aye.
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 Any opposed? All right, we also have to approve the minutes of the closed session, which is rather, I've always found that to be oxymoronic because if it's a closed session, why would you have public minutes? But nevertheless, let's press on. May I have a motion to approve?
So moved.
Jody first made the motion. Paul Hample seconded. All those in favor?
Aye.
Aye.
Okay. Request for benefits. And gentlemen, we're going to get to you very quickly because you are the star of the show today.
Oh, well,
Okay. So get to you very quickly.
thank you.
The request for benefits, we have 14 civilian requests for retirement benefits. Becky, is there anything we should know specifically about any of these requests?
No.
Nothing controversial?
No.
Okay, fine. May I have a motion to approve?
So moved.
Second. Lieutenant Colonel Lohr seconded. All those in favor, signify by saying aye or raising your hand or both.
Aye.
Aye.
Any opposed? We also have 3 police requests for retirement benefits, well earned. We have a motion to approve.
Motion.
Second.
Jerry Laura, Jody seconded. All those in favor?
Aye.
Aye.
Any opposed? And now, unfortunately, we move on to death benefits. Civilian. I have here somewhere. Um,
On the backside. There are 9 requests for 5 decedents.
Okay. May I have a motion to approve?
Motion.
Second.
All those in favor?
Aye.
Aye.
And for the police request?
There were none this month.
Yes, thankfully. Thankfully.
Early.
Next order of business is a presentation from Granite Management. We have 2 gentlemen here. You can introduce yourselves. Were you being joined by a colleague?
I know, it's just
Just the 2 of you.
right here.
Okay, fine. Great.
And maybe, Bill, if you don't mind, just 20 seconds for me. So again, thanks to Bob and Jeff, who will introduce themselves in a minute, but for coming from Granite. Just want to remind the groups, Granite, one of our small cap equity managers, one of 2, Ernest being our other one. But the board hired Granite almost a full decade ago now, back in the middle of 2014. So been with Granite for quite a bit of time. Over a long period of time, it's certainly been a great decision by the board. We've seen quite a bit of value added over time, but I've asked Jeff and Bob just to touch on, again, a reminder of who they are, their philosophy and process, but also just talk about a little bit, kind of the different environments they've experienced with us, and kind of how, when they performed well, when they haven't, and then just, an outlook on, not just the economy, but really kind of why they like where they're tuned down the portfolio. But as always, please, guys, feel free to hop in with questions at any time.
Perfect. Thank you for the introduction, Finney. Pleased to be here. I'm Bob Ferran. Jeff Ho, along with me. Jeff is the lead portfolio manager on the strategy. Both of us are senior partners at Granite. I'm also, as you see, the chief compliance officer for the firm. As Finney said, we've been working together almost 10 years. I think it was 10 years exactly. I forget if it was the March or the February board meeting 10 years ago that Jeff and I first presented to you up on the 8th floor, which is where we were trying to go earlier. So we really appreciate the longevity of the relationship. We'll touch on the little update on the firm, and then spend most of the time on the portfolio, and as well as our outlook, as Finney alluded to. And we'll keep in mind the 30 minutes that we have here. So any questions, please feel free to jump in and ask, and we'll leave some time at the end for questions as well. So within the electronic version, and I don't know if you have some hard copies with you here, but on slide 3 is a brief overview of the firm. Granite came into existence in 2009.
We do have hard copies.
Okay, you have, okay, so on page 3, we're 100% employee owned. We've always been that way. We have 20 team members. We have our main office in LA, a satellite office up in San Francisco, 4 billion in assets. You can see the breakdown on the slide here with regard to the different strategies that those assets flow into. And we work with clients from across the board: corporate plans, public funds, foundations, and endowments. On the institutional side, we also work with some intermediaries on a sub-advisory basis as well. Well, I tell you, it was right, August 1st of 2009. So you can imagine it was
Well timed.
well timed. No better time to start than at the very bottom.
Yeah.
So I don't think there's any genius in that. That's the way it came about.
Well, actually, you missed the bottom by a few months. I think that was in March.
That was in March.
Yeah.
We did it in 2008. That was an experience.
Yes. So, and just a little more on the firm on page 4. I'd like to illustrate the well-distributed ownership across the partners at the firm. You can see that at the bottom. There are 8 senior partners or managing partners at 10%, 2 at 5, and you see 5 junior partners here. So Jeff and I have taken some dilution over the years in order to provide equity to employees and to the way of retaining talent. And if you look closely here on the junior partners, they're all associated with the investment side of our business. Slide 5. And I mentioned we have 20 employees. We're focused on 2 things, really. We're focused on research and our clients. So the research flows into portfolio management, of course. We do work with third parties, for instance, helping us on the back office, IT, who you call if your computer doesn't work, compliance, admin, what have you. So all of these third parties we've worked with for well over a decade now. So very much a stable environment for us, helping us deliver what we do for our clients. On slide 6 is the small cap team. Jeff Ho, you see at the top as the lead portfolio manager. His role is as the final decision maker and the leader of this team. When Jeff and I presented 10 years ago, there were only 3 members of the team, Jeff, Peter, and Josh. In the interim, we've added 4 more team members. All these 4 over that 10-year span have become partners of the firm as well. And we are actually bringing on board a junior analyst in 2 weeks. So we're always looking to reinvest and provide whatever resources are necessary to the investment team, and we're committed to that. Slide 7 is a quick snapshot of the balance of the firm. We manage large cap portfolios as well. I'll skip past that to slide 8 in the interest of time, and I'll turn it to Jeff in order to provide an overview of the strategy, and then we'll get into our recent history and our outlook. Great.
Thanks, Bob. So the small cap portfolio, we've been running since 2007. We own exactly 60 names in our portfolio. And the idea is that you want to have concentration. Why 60? You want every buy to drive a sell. So we've got the opportunity to invest in various areas and important catalysts that we find over time. And yet, we're never, for those names that haven't worked for us, we don't want to keep them, in the portfolio as sentiment. And for those that aren't working, we want to be challenging them all the time with the next names on our wish list. So 60 names, every buy drives a sell. We do manage 3 portfolios within our team, small core being by far the most important. Below that, we run a microcap portfolio. And the idea there is for those companies that are really not complete yet, but have a lot of promise, let's own them for a more risk-tolerant client base. And as we get to know them and owners, let's promote them into a small cap portfolio. And that's how we kind of maintain our bias towards the smaller end of the market cap range, and it's appropriate. So frequent is not infrequent for names, at $1 billion or less to get an entry-level piece into the portfolio. And we own them for 2 or 3 years in a true microcap portfolio. So we know them really well by the time they're in this portfolio. The flip side, a little bit further up cap, if names come down, from mid cap into small, we might build them also. So kind of understanding the whole spectrum. In addition to that, we're, pretty broadly allocated across sector. And by name, 5% would be sort of a max position that we've owned in this portfolio over time. So we're fully invested at all times, never more than 5% cash. And since every buy drives a sell, pretty easy to tell, what our annual turnover is by name.
Sure. Thanks, Jeff. On slide 7, or excuse me, let's go forward. Slide 9. Performance summary for our relationship. Keep on mentioning it's been 10 years. I think that's just fantastic. You can see in the it was middle of 2014 that we began to work together. The top left, you can see the full calendar year performance year by year. You can see, relative to the benchmark 2015 and 2016, we're facing headwinds. And actually, we were in front of you in 2016 explaining those headwinds and our outlook. Coming out of that, we had several years of good performance, as you can see. We faced 22 and 23, we faced some headwinds. We'll discuss that further as we get into the presentation here. But you can see the breakdown. In spite of the recent headwinds, our longer term performance has delivered alpha above our net returns, as you can see, over 5, 7, and since inception. On the right-hand side, you can see our inception market value as some of the dollars and cents associated here, rather than looking at percentages with regard to market appreciation and what have you. So let's get in. Oh, question.
A couple. Your median market cap is $3.2 billion, which is about 3 times the median market cap of the Russell 2000. Is the Russell 2000 the most appropriate benchmark for you?
It is appropriate, and we judge ourselves more towards the weighted average market cap for the benchmark being about 3.2 billion currently, and we're at about 3.9, a little above that. But relative to other small cap managers, may have even higher weighted average market caps in the, say, $4 to $5 billion range.
In small cap.
So our definition of small cap is our playing field would be the Russell 2000 index. And Russell 2000 index has companies, 10 years ago when Jeff and I presented, I think the top of the Russell 2000 index for small cap might have been $2 billion, might have been $1 billion. The bottom being, say, about 100 million in market capitalization. So currently, as markets have expanded, what have you, the top end of the Russell 2000 from a market cap standpoint is about, I think with the latest reconstitution, about 7 or 8 or 9 billion. There is one name in the Russell 2000 that is now about 60 billion. That's undergoing an AI craze.
Supermicro.
Supermicro. That'll be reconstituted or out, but we're up for fighting a good fight against that. But yeah, that's our playing field. So it's a subset of the Russell 3000, which is the overall market. Top 1000 being large cap. Bottom 2 being small.
Okay.
Yeah. All right. We'll turn over to slide 10, and we'll talk about the near term performance, and I'll let Jeff.
I had one other question.
Oh, I'm sorry.
I'm looking at your performance versus a benchmark for the last 3 years. And it seems to me it comes down to the fourth quarter of 2023, as well as 2022.
Correct. Yeah.
Can you explain those, or are you going to get to that?
We're going to do that right now.
Why not?
Yeah.
Can I one follow up on the small cap question? Have you tended to skew towards the high end of the Russell?
Actually,
Or is that just current market?
Current market, we're a little bit above the weighted average market cap. Relative to other managers in our space, we're probably below our peer group. But with the influence of our microcap portfolio, we're comfortable bringing in companies earlier in their growth, if you will. And that sort of tends to lead us towards being, say, even with the benchmark from a weighted average market cap standpoint, or even a little bit below. So, and we've also tempered our size by limiting the amount of assets that we do manage within the portfolio. So we are nimble enough. We're not facing liquidity constraints as far as bringing some of these smaller companies in the portfolio, because we've limited the number of relationships that we do have in the small core portfolio to where we are now. And we've had that in place, that limit in place for like the last 5 years or so.
What's the limit?
Well, we're at one point, we closed the strategy to new business, to new relationships, probably about 1.3.
Okay.
And we're at 1.8 billion currently. So that's just market appreciation. And we feel we can handle the market appreciation because that's essentially the whole market growing and becoming more liquid.
Certainly.
Yeah.
One other question on page 9, if I can.
Sure.
The turnover in the portfolio for 2023 was 64%.
Right.
Is it, number one, is that typical? Number two, is that trimming or is that a substantial turnover of names?
Both. We've got a slide with all of the names and ins and outs of the portfolio, but that does include trimming as well. So perhaps just a.
Well,
Yeah.
wait, I will constrain myself now and we'll hear the presentation and maybe that'll answer all my questions.
Okay, if we don't, just let us know.
Certainly.
Yeah, okay. So on slide 10, we'll get into the fourth quarter and first quarter 22 where we struggle. And we'll go from there.
Right, so slide 10, you can see the first quarter of 22 was a difficult one for us. And that was driven primarily by the beginning of the Ukraine war. Even though, we manage small cap, a reasonable number of our companies had international operations. And a lot of those supply chains were really interrupted, with the war, whether or not raw materials were coming from Russia, or if it was the price of items going into Europe in general. You probably heard about chemical plants and other items in Europe which experienced force majeure because of all those disruptions and changes in shipping rates. So that was a difficult quarter for us. I think that hopefully that explains most of it. So the fourth quarter of 23, if you turn the slide, we can give you a sense there. And the fourth quarter was unique in the sense that October 27th was the bottom of the market for the year. Banking crisis back in March notwithstanding. And then, the end of December was the peak of the year. So it was the biggest intra-quarter change that we've seen in the history of the Russell 2000. So probably at, minus as low as minus 9-11% in October. So you can see in October and November, we were roughly in line. And I think in December, with the change of the Fed and how they were predicting what interest rate cuts would be in 2024, that did start a bit of a beta rally there. And so from a quality point of view, we look at all the names that we have in our portfolio, and everything we owned at the time in the fourth quarter was cash flow positive from an EBITDA point of view. From a risk point of view, our balance sheets were strong. And I think what we saw was a resurgence in some names that didn't have as good balance sheets, or part of the overall universe that was losing money. So that's where we stood. And I think, we were reasonable in that sense for most of the year from that point of view, in the sense that it was very difficult to raise capital for most of 2023. So you can see in December, that's where, the pain that we had mostly occurred. So what sectors were impacted by that? The first was probably on the banking side. In general, we're underweight banks. We have been underweight banks for the duration that we've been managing these portfolios. And the reason is that, strategy-wise, banks have a difficult time competing. Their most important factor really is their geography and whether or not population is growing. And even coming out of March, it was certainly difficult, to think about an overweight banks from our point of view. And even as we look forward, we've just came from a bank conference and everyone is still trying to assess how do they feel about their commercial real estate exposure. So I would not be surprised if we continue to be underweight banks going forward. And so I think that piece was probably something we'll earn back in 2024.
Now, the comments you just made are unique to the small cap banking sector. If we were talking about the large cap banking sector, you may have a somewhat different point of view. Is that correct?
Possibly. Yeah,
Possibly.
I think
Still very selective, even in large cap, I would imagine.
I think so.
In small cap, it's hard to be selective at all.
Unless you really enjoy the geography and you can build the case that the loan exposure is highly focused on CNI loans. Yes, I would see. But over time, regulations have really made perhaps the diversity of business opportunities that banks have.
Yeah.
And that's why you hear a lot about, private loans now.
Yeah.
A lot of the higher risk, subprime business that we had worried about in the 80s has really migrated to a different set of lenders.
Different title.
Yes. Correct. So.
Now it's called private credit rather than,
Private credit, probably heard of it.
I think the second reason that December was difficult was because biotech had a run. Most of biotech is, as you might guess, doesn't even have revenues and is certainly burning cash. We have a portfolio of biotech companies. At the very minimum, we're looking for companies that have an approved product. However, it usually takes 2 approved products to get you to a point where you're generating cash flow. But that being said, with the use of what we call biotech surrogates, such as life science companies, such as molecular diagnostic companies, and specialty pharmaceutical companies, we're able to get at least to a market weight. So in that chart below, you can see sort of the 6 names that we own in this portfolio that give us our biotech exposure. The Russell, biotech in general was up about 22% in the fourth quarter. As you can see, 4 of our names performed there. 2 of them had, however, negative clinical events that prevented them from performing. So that was the biggest piece of the biotech performance. So I think the point is that we're certainly investing in biotech, but I think we have a level of selectivity to make sure that our upside downside is hopefully a little bit more constrained.
Just, I appreciate the feedback on the difficult quarters. The 2 years prior, 2020 to 2021, were both periods of outperformance. My recollection was during those years, it was difficult for small cap managers because you had this meme stock buzz going on where the retail traders were taking positions in select companies, maybe not based on fundamentals, which were driving some index returns, maybe through lower quality names. How would you characterize your outperformance, or where would you say your outperformance was coming from in those 2 years?
Yeah, I think if you go back to March of 2020, that was for the beginning of COVID, right? And markets corrected rather dramatically. And I think what that gave us an opportunity to do was to buy back a lot of companies that we had owned previously in small cap, maybe names that we had quote unquote capped out on that had gotten beyond the small cap realm. So when you have a major market sell-off like that, we find a lot of companies come back into our market cap range, ones that we know really well. And that gave us the opportunity to completely change the portfolio in the second quarter of 2020. So that would be a period of extreme turnover. You don't see them often, but it turned out to be our benefit. So everything we owned then really worked for the rest of 2020 and for 2021, and even parts of 2022 also.
Yes.
one more question on page 13, which is illustrative of my point of turnover. What is your sell discipline?
So the self-discipline is, in a very basic sense, as I said, we own 60 names.
No.
Every buy tries to sell. So as we build our wish list of companies that we're following and we want to own, at the point where we're not thinking of even adding to an existing position, it should really be a source of cash. So it could be a company that's up dramatically, and yet we're not willing to add to it at that point. We should probably be using it as a source of cash. The flip side is putting that down dramatically. You would hope that we'd be adding to it, but if there's a negative change in fundamentals and we're not willing to add to it, then we should be replacing it. So in a very hopefully positive sense, our pipeline of new names on buys are driving our sales. That's hopefully what's
I
happening.
understand. So
It
it's
doesn't
not,
always happen like that.
so your sell discipline isn't reliant upon or dependent upon or driven by technical factors or technical analysis. Is really more fundamental analysis. Is that correct?
Yes.
Okay.
So would these 0.1 and 0.2 position sizes be the targets for seeking replacement?
Great question. So that would be an average over the year. It's not representative of the position we had at the time of sale.
Okay.
So if you sell something,
Maybe a full position size just come in later at the end. Okay.
correct. So if we had something in January and we sold it by the end of January, it might come in as a 0.2. Yeah. So, since you turned, Bob,
Yeah, continue.
since you turned to slide 13, let's take a look at that. Obviously, the turnover was a little bit on the higher side last year. So the reasons for that would be that we had really 4 events of extreme volatility in 2023. The first quarter is the most obvious, would have been Silicon Valley Bank and First Republic, going under. So that drove overall financial distress.
Yeah.
The second quarter was really driven by AI and ChatGPT and the introduction of that. So both beneficiaries and those who would be disrupted. The third quarter was driven, you can believe this, by GLP-1s. So the biggest,
Ozempic and the weight loss drugs.
Yeah, Lilly
So-
and Novo Nordisk.
so suddenly no one was going to eat Fritos anymore, potato chips. So interestingly, we don't own any consumer staples in this portfolio generally, just because they're not in our market cap range. But large cap consumer staples, as you talk to your large cap managers, will tell you they took a huge dive, dramatic dive from liquor and beer all the way down. Suddenly, no one was going to be consuming excess calories, which was an interesting situation because brands, the biggest attractor there were major, well-established brands such as Pepsi, amongst others. So Mondelez, of course. From our point of view, the biggest difficulty was for medtech stocks. So suddenly, there weren't going to be any hip replacements. There weren't going to be any knee replacements. And that was the most difficult part of our portfolio, was seeing suddenly there wasn't going to be any heart disease.
Yes.
So all of our medtech stocks took a 30 to 40% trim. So that was what impacted the third quarter. And of course, the fourth quarter was changed in the dot plot by the Fed. So with all of these competing factors, one sort of every major quarter, it did lead to a reasonable amount, of volatility relative to prior years, I believe.
I want to turn my prior question around. Rather than talking about what drives your self-discipline, why do you add a company to your portfolio? What are you after? Are you after minimum expected 20% gain over the next 12 months? Or what are the factors which drive the buy decision?
Right. So what we're looking for are companies that have business model that we think is going to drive it, a management team that can steer it, and a balance sheet that they can support it. All 3 of those things are what we're looking for. If it doesn't have those 3, hopefully it's a microcap company and we can own it in that portfolio and watch it mature and then promote it as it gets close to $1 billion market cap. That's sort of kind of our general threshold here to promote it up. And we promoted about 5 different companies from our micro into our small cap. At that point, we're hoping it's a 3 to 5 year investment, or it is on its way to becoming a mid cap stock. So for instance, a great example of that last year would have been a less than truckload trucking company called Saia. Saia competes with its larger cousin, Old Dominion, which many of you have probably seen on the road before. That was a $1 billion small cap company back in 2007, right at the threshold of the great financial crisis. And we knew that company well. Saia, at that point in 2007, we owned our microcap portfolios and got to know them really well. And so when the great financial, the crisis happened in March of 20 with COVID, that's essentially when we bought Saia. So at about $1.5 billion, and as it got to be June, it hit $9 billion and became a source of cash for these portfolios. So in that sense, we owned it for almost a full 3.5 year cycle, and watched it, having known it as a small regional LTL company. watching it become a national company. What was the catalyst? It was, Yellow going through its bankruptcy proceedings. They were the bad pricer in the market. Take out that bad pricer, redistribute their terminals and assets amongst more disciplined players, suddenly Saia's multiple effectively doubled.
So you do or do not have a minimum expected return or minimum expected earnings that drive your buy decision? I'm trying to understand.
Fair enough. Yeah, so no,
To both.
but I think what we're looking for are good companies that we can own for a long time. At the onset, I think, as we look at small cap companies, things change in the sense that they can make an acquisition. They can bring a new manager of the business. They can have big upgrades in each of those that completely change the profile. So we try to take as holistic a point of view as we can, knowing industries as we can, applying our 5 forces analysis, and thinking about, each sector overall. Why is that important? Because you bring up a good point. And if you go back to maybe different periods of time, say, 2016 to 2017 to 2020, when we had tremendous outperformance, a lot of the companies that drove that performance were companies that were growth companies, and they weren't making money yet. So how am I going to necessarily impute that today or 1 year from now? Suddenly I'm kind of applying more of a 5 to 7 year DCF. And that's really important in areas of growth like technology, right? And certain parts of healthcare. The flip side would be on the value side of our portfolio. We're imputing in different ways. The analysis that you're talking about makes a lot more sense to apply. It's a lot easier to put that on a spreadsheet and think about what the cash flows will be in the next 2 years as opposed to the 5 to 7 years out. And that is the exercise we're doing every time we buy a biotech stock effectively.
Good, thank you.
Jeff, can you just talk a little bit about your view and exposure with REITs? This conversation that this board has had a couple of times, so your thoughts on there.
Yeah, so on the REIT side, the most important factor is going to be interest rates, right? So to the extent that we think interest rates are going to go down, it can be really helpful there to REITs in general. The thing about REITs is that you inherit the balance sheet. If you're 6 times levered, nothing can change that because you have to pay out everything in dividends. The only thing you can do is do a capital raise. So it's only a very specific kind of REIT in general that has the, that Wall Street trust to raise capital and grow by raising that capital by doing deals that are going to be accretive. So from our point of view, we've owned a industrial REIT in this portfolio for several years to now, and they just raised capital last night. The Street does trust them to, do accretive deals in the industrial space. Their area happens to be coastal markets with shipping effectively. So Los Angeles, San Francisco, Seattle, Miami.
Land shipping or ocean shipping?
Ocean.
Ocean.
The second REIT that we own would be Outfront Media. That's billboards. Billboards is the only part of traditional media that has kept their market share. So television obviously has been ceding share. Publishing has been ceding share. Radio has ceded share. Outdoor, however, has maintained 2% of the general advertising market for the entire internet era. So Outfront is one of 3 national players on the billboard front. And so why can they generate outsized growth? The answer would be because in 2023, we think the advertising market hit the bottom. And if you believe that 2024 is the beginning of better times, advertising is going to grow. So why did it hit a bottom? It was cyclical low because people weren't driving to work. So as we have more people go back to work, we do believe that the number of seeing all of the billboards is going to improve. And that's, going to drive some outsized cap, similar to what we saw with this company in 2018 and 2019. So we think we're getting a bargain. About maybe 20% of their cash flow is driven by New York subways. So kind of how low New York subways went. So the rebound we think we can have there off of that bottom from when we bought it, is going to be a part of the driver there.
Excuse me, I'm not going to make you digress very much, but are you comfortable that they have models that really tell them the effectiveness of their billboard advertising?
Yes.
Okay,
Yes.
I trust you. It's hard for me to see how that would be the case, but you're the one who studied the area. You would know.
So these are national, it's interesting, there's 3 national networks now, and you've seen with digital billboards now, you can put up 6 ads per minute. So if you are stuck in traffic, you can see 6 billboards. But with cell phone tracking, wiping out, anonymizing who you are, I think you are actually able to do a decent job of tracking the number of eyeballs passing. Not as good as CTV now, right? Not as good as internet banner ads, but pretty good.
That's fine. Okay.
You mentioned Toronto.
Toronto.
Yeah, Toronto. I agree, Gregory. I don't see it on the portfolio. Just looking at it.
That is.
These are the
this
new
is
ads.
the 5. Yeah, I'm sorry, Toronto we've owned for 6 or 7 years. It would be on the next.
This is only.
5 positions, sorry. Yeah. So if you look at page 14, you can see it,
Got it. Okay.
real estate niche market.
Mhm.
Yeah, exactly. We've owned that for 6 or 7 years. That's what that is.
It's subsequently represented as 16, which showing the portfolio as of 12/30.
Okay.
So maybe I think might be helpful for the group, and I don't know if it's on page 15 or just more broadly, but this kind of breakdown growth, value, core within, then how you approach that in the portfolio.
Sure, yeah. So if you take a look at this style matrix here, if you look across the top, you can see the sectors as identified: technology, healthcare, financials, each with their own, separate sector-related data. And then if you look on the left-hand side, you'll see the categories that, Russell as sort of the official arbiter of the index gives it. So as you can see, we're about a third growth, a third value, and then a third blend, which would be those companies that have both growth and value characteristics. So, and I think the idea there is that when we feel it's appropriate, we can lean growth, and when we feel it's appropriate, we can lean value. And hopefully, it's really the companies themselves that are driving that opportunity. But as a portfolio manager, with our position sizes, that gives us the opportunity to lean either way. So right now, as you can see, at least entering the year on January 1st, we were much more neutral overall between growth and value.
Mhm.
Everything with a double plus next to it, in addition to that, is a company that pays us a dividend. So about 40% of our companies pay us dividend. And as I said, entering the year, every one of our companies was EBITDA cash flow positive. It's interesting, I think, just in February, we added to the portfolio the first company in over a year that was burning cash. So in the life science biotech space, and it is sort of a toe in the water to see what is the risk profile that we're looking at for the rest of the year. You've probably heard this. In the first quarter, biotech did a decent job raising capital for the first time in 2 years. It would be kind of like a public down round, if you will, from a venture capital point of view, dilutive, in other words. But it is important to think about at what point does the risk profile of the market change such that we're willing to tolerate, once again, growth companies that are not going to be generating cash in the next year or two. So, so that company is down a little bit since we purchased it, but once again, it's a toe in the water to make sure that we're on top of changes, in sentiment in that way. And that might represent the market like we had, more in 2018 and 19, or, even the latter half of 2020 when we had the SPAC, the SPAC IPOs.
On page 17, you indicate that your active share is 95.17. Can you define active share for the benefit of the board?
Sure. So maybe the best way to think of it would be if you were a large cap manager and you owned the Magnificent Seven, Google and Microsoft. That would almost be like passive share because you're owning exactly what your index owns. With the Russell 2000, we are right now with, as you mentioned, Supermicro, in a situation for the first time, really only for the third time in 25 years where a single company is 1% of the index. With 2,000 companies, almost by definition, no company should be, substantially influential. But, really since the .com and one small period during COVID, there is a company more than 1% of the Russell. That would be called Supermicro. And, if we had owned it in 2023, we probably would have been sellers on January 1st. Because to start the year, it was 15 billion. That is pretty far above, what we consider small cap these days. And today it's 60, so it's kind of part of the index until June 30th. So the last time that I remember it happening was 1999, really. E-Trade was a $25 billion company, and that certainly came back down to earth. They had some great ad campaigns before selling out ultimately to Morgan Stanley a few years ago.
Valuation is better with Supermicro.
Okay.
That's a company that have my clients' portfolios.
Mhm.
Valuation's actually not bad at all in spite of the increase.
Yeah.
But I'm not here. I'm not managing money for the county, so we can press on.
All right, well, I mean, we can continue, or we can, I'm not sure how much more time you'd like to spend with us. But, we can, we do have a slide here with regard to the risk profile of the portfolio. Jeff can give you an idea about where we are on the risk spectrum and wrap up from there. That would be on page, we'd be backtracking a few pages. It's 14.
Okay. Why don't we cover that and that should be
And
good.
then we can wrap up.
Yeah.
Great.
Yeah, so the first day of every quarter, we sit down as a group, as a team, and we talk about sort of the comprehensive risk that every name in our portfolio adds or detracts from overall risk to the portfolio. If you take a look across the top, once again, those sectors as you think about them and their kind of sector-specific data. But on the left-hand side, you'll see a category that helps us encapsulate sort of company-specific risk and all the factors that are happening and valuation. So emerging companies, are true growth companies. Hopefully we bought them a little bit earlier in their growth cycle, but what we're admitting to ourselves day one of the quarter is in a major market sell-off, these are the names we own that will underperform. Asset value companies are those companies that compete with mid-cap and large cap companies. And we think these are great acquisition candidates over time. Niche market companies are those companies that have really innovated their entire space over time and have built out great barriers to entry such that, we think it's difficult to compete with them. And then undervalued companies is a bit of catch-all. It can be cyclicals at the bottom of their cycle. It can be falling growth angel companies. It can be companies that maybe made an acquisition at the wrong time of the cycle and find themselves over-levered, or they've lost their management team, kind of sort of like how certain basketball teams are losing their coaches today. So either or, we consider these companies to be undervalued to the point that any major market sell-off, they would actually underperform on the downside. So outperform on the downside. So the idea here is not to fill out every square, because clearly we don't, but it's to help us think about position sizes entering the quarter. So for instance, it's okay to have a large position in an emerging tech stock, but we do want to ask ourselves, do we have any names on the periphery of the portfolio that we should be adding to maybe offset some of that risk that we perceive entering the quarter? we tend to have 6 defensive names in the portfolio at all times. So something like a Casella Waste, a waste utility in the Northeast. We've owned it. It's been a great stock for us. If we are feeling a little bit more that we want to own a name that is a little more growthy, this might be a good one to offset some of that risk entering the quarter. We can add to that and offset it. So that's the conversation piece that we have every first week of the quarter as we're thinking about position size changes.
Mhm. Tom Lee has been consistent in his view. He's market strategist.
We use,
Some
we talked to
are now. Consistent in his view that his model suggests a 50% increase in the small cap sector, Russell 2000, this calendar year. That's what his analysis would suggest. Are you that bullish?
So for us to be that bullish, I think we would have to have rates come down. That's help. That would be the start. That's not the end. I mentioned that we bought a starter, toe in the water position in a company that's burning cash. It's growing fast, but it's burning cash. It might have 2 years of cash on the balance sheet, but it's going to have to fundraise. So the question is, how does the market receive that kind of name? So for Tom's analysis to be correct, that's the scenario we need. It's not just rates coming down. It's the fact that the company wants to own growth companies that are burning cash. As we look at the performance of the top 10 names that we have, that would be on slide 17, all 10 of these companies, the reasons that they're performing is that because they have improving ROIC. I haven't mentioned that because that's usually much more like a large cap kind of metric, but the market today has been very much focused on companies that have improving ROI, return on invested capital. So, and that really favors asset-light companies that don't have a lot of physical assets relative to their business models. So something like CBES, which is a roll-up of accounting firms, that is a defensive position for us, but it has been offensive as possible over the 7 years that we've owned it. It's a great example.
From an appreciation perspective.
Yeah. So very surprising to us, but that really represents kind of the market we're in today. So for Tom's scenario to work out, I think that the focus on ROI as an important metric would change. And I would say most of the time in small cap, it's a lower priority. The priority is typically on top line growth. Having just come from a major software conference in San Francisco, the first week of the first week of March, it did feel like the discipline was there still, because if it wasn't, people would have said to us, I'm going to grow my sales force 20% this year. And no one said that because they just slashed them 25% in January of 23. So at least in my mind, from a tech point of view, I'm waiting for people to say, I'm going to grow my sales force, right? On the biotech side, we did get a little bit of the fact that there's a little more interest because cash burning companies were able to raise capital again, right? So we haven't had a huge biotech rally yet. It's not one of those sectors you look at and say, we're at prior peaks, such as in semiconductors. But that's what we have to be ready for. And that's why we took that small position.
Well, for your benefit and ours, I hope Tom Lee is correct. Tom Lee, for the benefit of some of our board members, was the chief domestic market strategist for JP Morgan for a period of time, and then founded his own firm, and actually has been remarkably prescient over the last couple of years. So I hope he's right.
Me too.
I mean, even if he's half right, it's a successful year.
He's an important person to keep because I consider him to be a firmable.
Yeah.
Which, if you're looking long-term in market, that's a good position to be in, right? But he gives you the perspective of optimism at all times. He's a very optimistic person.
Okay. Well, so am I. Hope it works out. Thank you very much.
All right.
Appreciate you coming
Thank you for
in.
your time.
Appreciate it. Thank you.
Can I ask a quick question?
Yeah, Sri, please.
So you're obviously a bottoms-up manager doing your research in-house, and you talked about a 5-year hold and free cash flow and so on and so forth for that all to work itself out, which all seems very reasonable. And then I tried to see that your typical holding period, however, was about 6 months. If we look at the turnover, how do you reconcile that?
Yeah, great question. So a few things will add to turnover. So for the best case scenario is that the stock is no longer in a market cap range anymore. So examples of that would be Saya last year.
No, I understood that the first time, and I appreciate that. So I don't want you to repeat what you said about turnover. I guess my question is the struggle of a typical, from what you're saying, it would take a small cap 5 to 10 years to, as you correctly said, to basically perform and show. But yet, with that turnover, you would never give them that chance. So how do you reconcile that?
Yeah, so great question. We do a lot of research. We talk to every person on my team aspires to speak with 150 companies every quarter. So we're on the road constantly visiting companies, at their headquarters, at investment conferences, at trade shows. So I think what you'll see is that there's a bit of a core and a satellite approach overall to the portfolio. You can see that probably half of the portfolio, has been there for a while. And then the other half is constantly being challenged by new ideas that we find on our wish list. So that's also being challenged by changes in like we said last year, the 4 changes that we saw in the macro environments, and with people, management teams changing and acquisitions being made. So it's very dynamic in that sense in small cap where there's that much change happening. So as things change, we react to it. So to the extent that, hopefully half of the portfolio is staying consistent year to year, I don't think it's unusual, to see in any portfolio those changes happening more on the periphery overall as we see opportunities and as names either perform or don't.
Okay. One more question. So, I'm looking at Reddit up 12% for the day. There's no doubt this is an excess liquidity / momentum market. What as you look at this portfolio and the market conditions, and I understand you're a fundamental shop, but what makes you lose sleep?
I think the thing that makes me lose sleep is war.
Is
War.
war.
Yeah. So as I think about ways I might extend duration to the portfolio, the easiest way to extend duration is to have more companies that are burning cash. The second way to do it is to have companies that have more leverage on the balance sheet than normal. So from my point of view, that's the difficulty I have on the balance sheet side, is extending my duration from maybe 2 turns of debt to buying something 4 to 5 turns of debt, is thinking about more global macro. So from a bottoms up perspective, as I think between if I want to extend my duration, would I rather have a cash growth company or a value equity wedge levered company? I'm probably leaning towards the cash burning growth company right now. Is that fair?
Okay. And is there a downside capture number your portfolio has?
Yeah, I believe it's in the Like,
Was it in there?
is it in there? Is it the low 90s there?
I didn't notice it, but it may very well be in there.
Okay.
Sounds like capture ratio.
It's not in here, but we can get that specifically back to.
Could you do so? And we,
Over several time periods.
yes, that would be helpful, and we'll obviously to Phineas, and he'll distribute it to.
And we typically have that on a tree, on our quarterly, presentation.
Okay. That's okay. Thank you.
We'll be able to do That, thank you.
Thank you.
Anything further, Sri?
No, that's good, I think.
All right, thank you.
All right.
Again,
All right,
Thank
thank
you.
you.
Thank you.
Nice to see you again.
Good to see you.
that's the way.
Bye, everybody.
Thanks, Gary.
Aye, thank you.
Thank you. Phineas? Got the floor.
Oh, perfect. Hey, if there's any questions or comments of that, we can, certainly happy to discuss that. The one thing that I do have two things, I guess, today. First, just a quick, our preliminary performance through the end of February. We have that performance report, talk a little about the markets, how our managers have done. And then just a quick update, stuff we've talked about before, but then just put some actual numbers behind recent transaction costs from some of our manager transitions.
Mhm.
So, okay, perfect. So Becky, that's, so why don't we go ahead to talk markets a little bit, and I draw your attention to the left-hand side of the page. Again, what we're showing here are the various equities, fixed income indices, how they performed. Again, this is all as of, we get to say this year, February 29th. And so the dark blue line is the February performance, the lighter line is the year-to-date, so just 2 months. So all in all, again, we entered January, there was a lot of optimism going through the fourth quarter, a lot of expectations of interest rates to fall quite a bit in 2024. As we moved into 24, those expectations have reversed a little bit. Ultimately, from a market standpoint, the month of January is very much flat, at least in the equity market from a return standpoint. We did see a pretty strong bounce, though, from a market standpoint in the month of February. Particularly, we started to see economic data come out, continue to be pretty positive. You can see here jobs, almost double expectations, new jobs being added during the month. We also saw in February, we start to get reports from companies on how they finished up the fourth quarter in their outlook, and those continue to remain positive. And so what you can see there on this left-hand side of the page is really strong from the equity side, dark blue bars up to the right. The S&P was up over 5%, small caps up 5.7%. You can see even international markets, particularly emerging markets, did quite well. So really kind of driving that year-to-date column, which again is only 2 different months. We did see bond prices at the bottom half of the page. Bond prices so far this year have fallen. And again, it's because interest rates have picked up a little bit. Going into the year, expectations were that the Fed was going to start cutting interest rates pretty soon and pretty significantly here in 24. Going into the year, the expectations that the Fed would make about 6 different rate cuts throughout the year. The Fed actually met just last week. Basically, that expectation was cut in half. There's been no rate cuts so far this year. The Fed, for the last 5 meetings, has left rates unchanged. But the expectation is there'll be about 3 interest rate cuts from now through the end of the year. So right now, the federal funds target range is between 5.25%, 5.5%, and expectations is by the end of the year that'll drop to about 4.5%, 4.6%.
Is it really realistic to think that they cut rates after September?
I started
With the election coming up in November? To me, if they're going to do anything, it's between June and September.
To be determined with that, Bill. I mean, there's
Without question.
for sure. There's a lot, there's been a lot of, obviously, there's always under a microscope, but especially over the last several years, how much politics is the Fed playing has been a big question. I think their preference would be that what you're saying is if they were to do anything, to do it, kind of leave that third quarter alone a little bit, so they're not accused of any, kind of political agenda. That said, they've also communicated very much that they are data dependent and they are data driven. And if the data continues to come out, that they should act a certain way, particularly to, let's say, lower rates, and it comes out during those times. My personal guess is that they would feel compelled to act, but again, it's to be seen.
I agree. I think it's unlikely, but both they and the Supreme.
I would
Court seem
imagine it's their preference to not,
controversial
but
at the moment.
correct.
All right.
Okay, so want to hit on our allocation, because, we've had discussion about this and there has been some activity. So on page 4. So again, what we are looking at here, this is all as of February 29th. So just over $850 million in the portfolio. You can see our target asset allocation, which again, we revisit, constantly, and every year, at least annually, we discuss with the board. We did so in January. Happy with our target asset allocation. And then you can see where we are over and underweights relative to these targets. And those kind of gray bars are those, kind of those big buckets, if you will, equity, fixed, real assets, and then underneath the sub-asset allocations. So a lot of this, not surprisingly, has been driven by market moves recently. We're over 4% overweight equities. That's about $36 million doing the math, overweight equities. Now part of this, you can see where that overweight really is within US equities, large and small, which should continue to perform well. Now, again, part of that overweight there, look down to that private equity. We're continuing to build out our private equity program. That takes time, which we've talked about. So part of that underweight is just by design. We know that is coming from there. But still, overall, we're about $36 million overweight, overweight equities, in the portfolio, and about 4% underweight fixed income. Again, a lot of this has to do with recent market moves. So just so I've been in all within the month of March, really the last half of March. First and foremost, as we do all the time, we're pulling money out of the portfolio to pay our benefit payments. And there was also a capital call that came from our private equity manager portfolio advisors. Again, they asked us for money and we make those contributions. So that was total, those two things, benefit payments and capital call, was about $5 million that was asked. So we did pull that money from Rumline, our large cap core manager. Our largest allocation was single manager in large cap equities. In addition to that, we're balancing the portfolio of $25 million. So pulling that from large cap equity and adding to fixed income. And of that 25, it's basically 10 million came from Rumline, 7.5 each from Aristotle and Jennison, our large cap value and growth. And then that's being split between Iron and Western. So again, that's not replicated, shown here.
So as of the end of March, we should be roughly roughly at what our target numbers are.
Correct.
For the
yes, closer to our targets.
Not that our targets represent infinite wisdom, but we'll be closer to those targets.
It's good to model our targets, and it's good to, again, every now and then rebalance. So just wanted to give the board that update.
Yep.
From a performance standpoint, if you want to flip to page 5. So again, as of the end of February, just over $850 million in the portfolio. And I'd point out first, just look at this. I mentioned January flat, February really drove market performance. And you can see that our 1 month return for February is 2.62. Our year-to-date return is 2.6. So again, certainly as February is driving what's happened so far this year. You can see relative to just the first 2 months, we are ahead of our strategic policy index by about 1/3%. And again, and then our broad policy index, which doesn't include real estate, we're behind. But again, real estate, these are updated quarterly in terms of return. And so there's no real estate return within our year-to-date performance.
So the 2.62 may very well be understated.
Right. We'll see affected by real estate. So again, it's been really positive. I do like looking at the 1 year, the 3 year, the 5 year. We've been kind of doing this these last couple of months because again, we've had this really strong rebound, particularly as Granite mentioned, led by the fourth quarter this year, has continued here, especially in February. So over the last 12 months, we're up over 11.5%, 11.67, right on top of our benchmark. But you can see again, moving to the 3 year, or certainly 2022, right? We experienced the sharp rise in interest rates, which hurt bond prices, also, certainly hurtful to equities. So our 3-year number, we're right about 3% on a per year basis. You can see below our policy index there. But then we also had 2 positive years, or at least close to positive before that. So our trailing 5 years, so since February of 2019, so certainly that includes both 2020, COVID, as well as 2022, we're up 7.8% per year. You can see about 0.5% ahead of our policy index again on a per year basis. So again, certainly as we know, markets move quite a bit in short periods of time. You can see over the last 5 years, certainly very strong performance. And then since inception, again, this goes back, to the 80s, we're up over 8.5% per year. Overall, so again, certainly strong performance over the last year. Overall, in all our managers, we think continuing to perform well. We'll hit just a couple highlights and really just kind of focus you down this 1-year column as we look at our sub-asset class and how they've performed. Our largest sub-asset class, U.S. large cap equity. Again, the S&P has done very well. The Russell 1000 done very well over the last year. Our benchmark up 29%. You can see our managers be able to outperform them. We're up 33% over the last 12 months. A lot of this has to do particularly with our growth manager, Jennison. You can see the exact numbers on the next page, but growth really driving some value over the last year. And Jennison certainly rebounded.
I mean, the 58%.
Yeah.
I think that's notable.
Yeah.
All right. If that's her opinion.
Not too shabby. So U.S. small mid cap. So this is Earnest and this is Granite. So you can see again, been positive. The asset classes over the last year, about 10%. Our managers trailed, and this really is the Granite underperformance versus the Russell 2000, and really kind of speaks a lot to that fourth quarter of last year that they just went through that's driving that. But you can see again, as we look over the 3 years and over the 5 years, our small Earnest and Granite, our composites together have shown pretty good outperformance. Within non-U.S. equity, so this is everything. This is our large cap developed managers. It's developed small cap, which for us right now is just William Blair, as well as emerging markets with Acadian. All of those 3 areas together, it's had a positive last 12 months. Again, we're kind of used to this U.S. outperforming international, which is still the case the last 12 months. But overall, non-U.S. has continued to add quite a bit of value. So our policy index, ACWI US, is up about 12.5% over the past year. You can see all of our managers put together are up more than that by about 4%, up 16% per year. 16% over the last year. And just kind of, again, where that performance is coming from, our 2 developed managers, WCM, and then part of the last year is half Sanderson, half Silchester, of course, because Silchester was added in the past year. Put those 2 together, you can see outperformed EFA by about 2.8%. Where we did trail was within small cap. We've talked quite a bit about this. Quality Bias and William Blair, as well as Mondrian, which is no longer in the portfolio, but certainly has been in the past year. We have a little bit of a 1% underperformance. And then Acadian, again, within emerging markets, continuing to really perform quite well. This is an area where quality has really helped over recent periods. So you can see that strong performance there.
Phineas, when did we have WCM in last? Do you recall? Have we
In
the last year?
Virtual. No, WCM, I want to say Mill was
March of 2020 is when we added them.
we added them. And I think they presented virtually during, how long we were all meeting virtually, but I think they did. So we don't have them this year. We can talk about it. I know we passed out the calendar last month. So William Blair is the international equity manager we were having coming in this year. But I don't think we've had WCM. It probably was 21, probably 21, I guess, maybe 22.
Well, there isn't much to criticize. I'm just wondering if they've done so well. I'd like to understand why people do poorly and I'd like to understand why people do well. And maybe there's some wisdom that we can gain out of that.
Yeah. So, and we can certainly bring them in. I mean, I will tell you.
Just look at your calendar, and if you think it's worthwhile to do so, if you can just factor that in.
Yeah, and then again, just a reminder for the group, we benchmark, at least in the quarterly report, we do show a little bit more detail. but both WCM and Silchester are against core benchmarks. But they are, we think, great complements to each other. WCM is certainly more of a growth manager and Silchester a value manager. And so that will drive
Yeah.
a lot of the differences.
Right.
Kind of really, fixed income, over the past 12 months, again, I do want to point out, particularly, Western, but also IRNM, they've definitely benefited from and have moved the portfolio around for some of these higher yields, right? So, 2022 was painful for us as interest rates rose, right? That hurt the bond prices and got some negative returns. But even just looking at over the past 12 months, fixed income being up about 3.5% for us. These are higher returns than we've kind of experienced over the last several years. And again, we do think it's both managers have been able to invest in some of these higher yielding investments, higher yielding securities, going to continue to help, build their absolute returns going forward. And then finally, within real assets, real estate, again, we don't have any data yet as of 24, but for the 2023, we talked about this real estate, really strong performance in 22, certainly fell off, particularly with higher interest rates and valuations in 23. But even still, again, kind of looking at the difference between the 1 and the 3 year real estate, even the Odyssey's down 12.7 over the past 12 months. But the 2 years before, you bring it together and it's up over positive 4%. So it showed some of that strong performance it had. And you can see our managers in aggregate adding somewhere between the 1.5% to 2% outperformance there. So no concerns with these managers.
I don't have any concern with the managers, but when do we expect some money back from our real estate?
So REIT continues, so they pay out quarterly.
Yeah.
And so it's typically the first month after quarter end. So we would expect in April to get another amount. We don't know exactly what that would be.
Okay.
I'm guessing that'd be somewhere between an additional $1-2 million.
Now that we're underway, are we drawing those requests or?
We haven't withdrawn those. We certainly can. I think we want to see what this one comes out to be, and then kind of our plan is, since every quarter has some time to look at them. Happy to go into more individual kind of manager performance, but do want to point out, so here we are kind of last week of May. Hopefully it has been another positive month in the markets. Actually, bond prices are up slightly, about 0.5% here month to date. And then both U.S. equities as well as international are up, between 2.5%, 3%. This is as of the end of last week, so maybe closer to 2.5% so far month to date. So again, we'd expect our March 31st numbers, end of the first quarter of our fiscal year, end of the first quarter of our calendar year, halfway through our fiscal year, to continue to be pretty positive.
Hold on for a moment. Our target allocation to real estate is 15%. Brian, do you think we ought to review that?
That's
The target allocation to real estate. You think we ought to reassess that? You're comfortable there?
Where would you put it? Mistaken?
Yeah.
Or do that?
Yeah, happy to comment on, to bring anything back to you like, but I think as we look at, everyone kind of knows the spectrum, equities and fixed income on from a risk return standpoint, and real estate does, certainly be in the middle of that. I think the clip Brian hit on the head, where would you put it? Our target now, we're already over 60% on the equity side. And,
Jaded by a back office market.
yeah.
Fixed income.
Yeah, Brian and I have some other experiences with commercial real estate at the moment.
But any questions as it relates to performance
No, fine.
portfolio?
When will we receive the real estate numbers?
So I think,
April?
so since we open towards the end of the month, I believe we're typically able to have our real estate numbers by our April meeting
Okay,
for March as
That's
a first quarter.
all right. There were a couple other things you wanted to touch on.
So I wanted to touch on, and we even asked about transaction costs for some of our manager moves. We do have a memo that's put together. And so again, as a reminder, over the past year, a little bit less than a year, we first made the transition to move from Sanderson to Silchester. And, that was, we redeemed Sanderson, it was about $55 million. And then we added 50 million to Silchester. We did hold back about that 5, really kind of similar to pay some benefit payments as well as a capital call to portfolio advisors. So 55 and 50. And then we also made the decision to redeem Mondrian in full redemption. We didn't add a new manager. We actually used those proceeds to add to Silchester, given kind of a new position in the portfolio. So kind of questions were, can we give an update? I know we've talked about this, but just update in terms of what transaction costs that did cost from an investment standpoint. So just looking at this, and you can see it there. So Sanderson, our full redemption from them, Sanderson, like most commingled funds, typically what they do is people that either enter or leave the funds, they charge them a transaction cost, so it doesn't hurt the other investors in the fund. So Sanderson did, unless they can kind of net those trades out. Well, Sanderson, if you remember, because we had gone through the process, selected Silchester, and then we notified them, Sanderson at the same time had other investors who were leaving, so they decided to shut down the fund. So because they were shutting down the fund, they did not charge any transaction costs, so there was no transaction cost to us. For the 2 times we were leaving Silchester, Silchester has that same dynamic in place where they charge the people coming in and going out.
You said leaving.
Going in or leaving. Silchester will charge people going in or leaving.
Mhm.
They will charge them, but Silchester does try to net that out. And so in other words, if for us, we're going in, and if they have clients who are exiting the fund,
They try to
they'll kind of just
manage.
swap, so they don't have to make the transaction costs.
Mhm.
And with all of our dollars, that whole 68 million that we gave to Silchester, they were really able to net all of that across. So we did not have any transaction costs for Silchester.
Good.
Mondrian, unfortunately, they were not able to net anything out, and so the cost was 40 basis points off of the transactions to exit from Mondrian. And so if you're to look at that in total, it's $75,000, and in terms of fees we paid, it really kind of all came from that Mondrian redemption, and 75 million on ultimately 74 million that was moved one way. It's about a 10 basis point fee that certainly well within expectations. We knew certainly could have been higher going through all that, but was asked to do things important. Just share that as an update with you.
All right. Anything else?
That is all we have for today.
Okay. Is there other business new business we ought to bring to the board? Maggie, when do you expect now to be complete with, or have completed the recommendations or the update, I should say, to our bylaws, ordinances, et cetera?
Ordinances, I think probably the earliest would be the May meeting at this point.
For Stuart's benefit, would you describe what you're doing?
Well, periodically, the board asks tax professional to make sure that our plan is compliant with current internal revenue code requirements. So we hired the law firm of Thompson Colburn to review the plan, and they're conducting that plan review right now. And then there may also be recommendations by the actuary and retirement staff and my office with regard to other sort of like cleanup provisions, nothing substantively changing benefits, but making things, clear that might have been a little bit unclear and those kinds of things. So, right now.
That's great. I actually have a question for ACG here. If I'm looking at this correctly, going through the equity allocation at this point is approximately 67%. Is that about right? Fixed income 18% and real assets 15%?
Correct, as of end of February.
Would that be pretty reflective of most of ACG clients' retirement plans of this size, or so on and so forth at this point? Or, is this tracking right at the other allocations? I understand different people have different goals and so on and so forth, but is this within the
Yeah, certainly. So, yeah, obviously the caveat, different people have different goals and objectives. But I think, Shriek, broadly speaking, ACG clients have a target equity weight between 60 and 65%. And which is, so that's kind of right in line with our target allocation line. Given market dynamics, most clients are overweight equities. I would say where we might differ slightly a little bit from, again, kind of broad strokes, ACG clients is within the fixed income and real assets. Maybe on average, it's closer to a 25 fixed income with a little bit less real assets, maybe closer to 10. And I think discussions have been in here with the group and the comfortability of real estate having a higher expected return over time. That's a benefit to the system and kind of where we currently sit. So that's where the comfort has been to have that 15-22. But overall, this, from the equity standpoint, yeah, target of 60-65% is certainly within line with the broader group of the ACG clients, with the bulk of our clients, again, being currently overweight equities, given how the market.
Okay. And what would cause you at this point to recommend lowering that exposure, or, I mean, we can say increase or lower, but more interested in lowering at this point. But what would cause that trigger?
Are you talking about lowering equity?
I'm just asking a general question in terms of how that trigger would come about.
Sure. So I think, from a target allocation perspective, so every year is typically at our January meeting, we do an in-depth dive in our asset allocation, and what we're looking at are, we have, like everybody has, our expectations going forward over the intermediate, longer term. And we do a lot of stress testing as it relates to certainly the volatility of the portfolio, but what drawdowns can be over different periods of time. And so if those projections, expected risk, we think would continue to move up, that's where we might make a recommendation to lower that target to equity, as well as certainly if the expected returns, if, for instance, whether valuations are incredibly high and we have other various inputs that go in there, that we're not able to actually hit the return that we want for the risk that we are taking, would recommend us to change that. But
so you believe the valuations are good at this point?
We believe valuations are, for the most part, fair. I think what's very important for us to keep in mind as well is we acknowledge, as we look out over the next 10 years, this plan really needs to hit that 7.25% per year. And so as we look at all the various asset classes, what do we think is the best mix that we think, again, we don't have a crystal ball, but we can comfortably say we're going to achieve that 7.25% return with, that's first and foremost, and then with the lowest amount of volatility, the lowest amount of drawdown that we can.
Sure. But I mean, I'm looking at a PE market PE of what, 21% and 21 right now, which is a 2 standard deviation event. Is that correct?
A PE of 21.
Domestic.
Yes, market PE is 21.
On a forward basis.
Yeah. So, and I think on average is, what is it, 17? So it's certainly higher. It's certainly higher than historical average.
Well, that's a 2 standard deviation event, which puts the market at a 3% event at this point, if that math is correct. So just wondering.
Well, so certainly, so the markets relative to themselves are richer, a higher valuation, which certainly goes into is why we're overweight equities, which goes into why we're looking to rebalance $25 million from our equity portfolio, add to other areas. But I think, Shriek, what we're saying is we don't have the preciseness to be able to say, okay, at this point, let's change our long-term strategic target to equity from 63 to 55, et cetera. Markets can certainly, run quite a bit. Something I didn't highlight, if you flipped out that page 3 here on our market update, that bottom right-hand side of the page, what we're saying here, this looks at, we're currently at, markets at S&P 500, Dow Jones are at all-time highs. It's one of those things, if you hit an all-time high last week and the market goes up, it's at a new all-time high. So what we've done is we looked at the S&P 500 going back 70 years in the middle of the 50s, said, all right, from every day that it's hit an all-time high over the last 70 years, what's the average return 12-month forward, 2 years forward, 3 years forward? And you can see 12-month forward, it's 8%, which is lower than average. It's average return, but still positive. 2 years forward, 3 years forward, still pretty high. So point being, yes, certainly equity markets can be expensive. We do think it's appropriate to rebalance and lower that. But ultimately, equities are still the best source of return going forward for a plan that needs to hit 7.25% per year.
Let me suggest this, because I don't think I provided what I'm about to describe to Sharik previously. You can correct me, Sharik, if I have. Would you send to me, I will send to Sharik, the analysis that you presented at our January meeting on your asset class expectations, and then the expectation for our portfolio, given our current asset allocation.
Correct.
And I think that would be a useful jumping off point, because right now we're speaking too much in generality. Useful, and I don't think I sent that to you, Sharik, but I may have. You have to correct me on that. But I would like to make certain that Sharik has that, as everyone else does on the board. So we have a common frame of reference of how we arrived at where we are.
Yep.
Then we can always choose to change how we arrived to where we are, but I want us to have a common frame of reference.
And we have been over the past few meetings discussing different risks in the equity portfolio. I mean, just you pointed out that just because we've hit new all-time highs doesn't mean it doesn't go higher. But in your evaluation in that center tier, the two asset classes that you have as overvalued are U.S. large cap and real estate. And until recently, those were the two sectors that we had as our overweights. And U.S. large cap has continued to go up, and real estate has, or the other way recently.
Right.
I mean, that we just want to, as we think through, how do we manage the different, we talk about concentration risk, what are the best ways to do that? So,
Yeah, I mean, I remember Chuck Prince, city CEO, saying that you got to dance while the music's on, and I believe that was 2007. And you're in the driver's seat, and I would just be interested in knowing, at what point do you recommend that some changes be made? That's all. Just policy changes in terms of what ACG and how it will, when the time is right, make those changes or recommend.
well, there are tolerance bands, and I'm forgetting what they are right now, around each of the different asset classes, right? So if it goes above a certain level, we have to rebalance. But while we're in that band, to the extent we're overweight, we can rebalance. And I think that's what you've been doing. Like, that's how you were funding the private equity request, which is underweight out of the large cap. You've been funding benefits out of, so that's you're using that as your source of liquidity to try and bring that back into.
Yeah, that wouldn't be significant, but yes.
Yeah, certainly. I mean, so it's, the bands, as Brian mentioned, the investment policy statement, I think Sharik will be helpful as the annual asset allocation review, where we look at various portfolio options. We analyze or break out, the various risks, the downturns, and how we model the portfolio, be able to share. And then, and certainly I think we can talk offline about this. Could be great, even just, as you're kind of just coming into the board, having you and I can carve some time to sit down and go through some of that history of what we've shown.
And in fact, Sharik, for new board members, we have often arranged a private session with a new board member at ACG, so ACG can take you through their work in detail. And we ought to arrange that for you. But you've just been appointed to the board last week, I think it was. And so we're running a little bit behind, but that is something else we will arrange.
We just took 25 minutes.
Okay. Sharik, I don't know if you said that was insignificant when we talked about those rebalancing things, but it's $25 million.
Yeah.
I'm not sure what your level for significant. would be.
I think Shrek is talking about the strategic asset allocation. When
Okay.
you take large cap or US equities from where they are right now to a lower level
So
or higher level.
adjusting the target
Here,
allocation.
here's what I'm saying. I'm just trying to understand, and I don't want to drag this on anymore. All I'm saying is that I'm looking at a market PE of 21, which is a 2 standard deviation event, which puts this kind of market performance at a 3% event, which is not your average year or day or whatever. And we can talk about liquidity and how it's driving the market, and it can keep doing that, sure. We're also talking about market cap at this point being 184% approximately of GDP. And I'm just interested with ACG being the consultants, what their thoughts were on this, and at what point we would see some recommendations to address this kind of valuation. That's all, just a general information. And like you said, Milt, we can take this offline later, and we can have a meeting, follow up on this or whatever to see, understand this better.
Right. And the last time we go through this annually on a formal basis. And we did so in January. And we can revisit things at any point in time. And of course, if something dramatic were to occur, that really it would affect our expectations for return over the next 5 to 10 years, not over the next year or two, but over the next 5 to 10 years, then we have to rely upon ACG to bring those things to our attention so we can at least consider them. We're talking about things which have a material impact on our expectations for a 5-year and 10-year period, given the fact that we're a pension plan.
Sure.
All right, so if you and I will chat, Sri, and we'll see what, number one, I want to provide you with the information that we already have, and then number two, we can set up a meeting offline, so to speak, with ACG, with Phineas and Jason and Craig. Was it Craig?
Craig was here last month, yeah.
Yeah, and Craig. And I think that might be helpful to bring everybody to the same point of knowledge. What we do with the knowledge, again, is always debatable, but we ought to be at the same starting point. All right. Anything further?
Milt, before we move on, I just want to set expectations. I think ACG gave me the recommended rebalancing on Thursday afternoon, and I've had a couple personal days off, so I'm going to work on doing rebalancing this week, but it's possible that it won't actually be completed by this Friday. So just to set expectation, I think Phineas said, oh, it'll all be rebalanced by the end of March. I'm working on that. I just want to make sure that everybody understands the expectations.
Sky won't fall. That's fine, Vicky. Do what you can do. The sky won't fall. All right, nothing more?
That's all for me.
Okay, any other new business? Any old business? Or we'll open up for questions from our visitors, of whom we have 2 in the room. And I don't think we have anybody else online, do we? No, Cyril doesn't have a voice. All right.
That's it.
You okay? Joyce?
Fine.
All righty, fine. Then I think we're at a point where we can entertain a motion to adjourn. Jody? Second. Paul? Let it be known that our county employee appointees recommended that we adjourn. Yeah, they've got to go back to work. The rest of us. All right, all those in favor say aye.
Aye.
Aye. All righty, good. No one ever quarrels about adjourning early, only late. All right, thank you.
Thanks, everybody.
Thank you very much.